everybody. I just want to welcome you to this new channel, this new series of podcasts, the Financial Wrap. I'm really excited about it, and I'm happy you're here to join me. On this first episode, I'm just going to take you through my first weekly wrap. Today is Saturday, July 9th, 2022, so I'll be wrapping the previous week with some articles. We'll take a look at some charts, and I'll just share some thoughts, and I'll do this on every weekend and just take you through some of what I'm thinking about the economy, the markets, just some thoughts on finance in general. Be sure to subscribe on YouTube. Be sure to follow me wherever you listen to podcasts. This channel and this series of podcasts won't only be these weekly wraps. I'm going to start some special series as well. I want to do some on just some educational topics like financial wellness, how to start investing, things like that. So make sure you stay tuned because I have a lot of cool things planned in the works. So without further ado, let's get into it. So this first article I want to talk about and sort of just scan through here is about Elon Musk actually saying he's backing out of his Twitter deal. Now, this is something that's been sort of back and forth for, at least 2 months, more than that now, a couple months now. He was originally going to pay a pretty big premium for it. I believe the exact number was somewhere around 50 plus billion originally, and then the offer he's backing out of right now is about 44 billion. So this article here from the Wall Street Journal says Twitter faces renewed questions on path ahead as Elon Musk tries to abandon deal. Before we get into this, and let's not forget that Twitter's faced a lot of turbulence recently. Jack Dorsey, the founder of Twitter, the former CEO, he has left to go on his other ventures with Square, which he has renamed to Block. I really believe that for him, he wanted to leave this behind because he has bigger passions in the crypto space and with Bitcoin, and I believe his plans will remain there. But let's get into this because I personally use Twitter a lot. I think it's a great platform, but there are definitely a lot of things wrong with Twitter. So Elon Musk is deciding to walk away from his $44 billion acquisition of Twitter after criticizing the company. And it's really just leaving a stain on the brand, I believe. I know Elon Musk was talking about his passions around freedom of speech. Whether that was really why he wanted to get this deal done, we don't know. I definitely have my questions surrounding that, but he's backing out. And what they don't really mention in the article here, and what I kind of want to get into along the lines of that freedom of speech is he was really concerned about the bot situation on Twitter. I believe originally in the original report he got when he was going to make the offer, Twitter said that they had around maybe 9% bots. I don't think that number was above 10% what they originally gave him. And he conducted his own research about the platform, and he said that he concluded that up to 25% of Twitter was bots, and he had a lot of big problems with that because he believed that really affected the valuation of Twitter, and he didn't want to be taking over a company that he was getting falsified reports for. And I get that. But to completely back out when he was saying that his whole reason for trying to acquire it was his passion for freedom of speech and protecting that just doesn't line up. And that's kind of feeding into the questions that a lot of people had before anyways. So the stock price has really suffered recently, already down 18% since Elon Musk offered. They fell about 5% after his decision that he's going to try and walk away from the deal. Twitter has already said that they're going to put up a legal fight. So that will be interesting to see how this plays out. I really do think, though, if he can prove that Twitter either didn't know how many bots were actually on the platform or that they falsified information about how many bots are on the platform, I think that it's going to be hard for them to really take any legal action if he can prove that. So that'll be interesting. But I want to get into kind of what the new CEO has been saying. And he says he feels like a lame duck CEO in the midst of all these talks, and after being appointed after Jack Dorsey left the company. 2 top executives are leaving the company. I mean, to me, this looks really bad. Like, if you're invested in this company, it doesn't look good stock price wise. It just doesn't look good from that perspective. But as a user of Twitter and someone that I really think that I can, and for a lot of people, really understand the value of Twitter and what it brings to the world, really, I see this as kind of like a power vacuum. So obviously Elon Musk saw the same thing, and he was trying to take control of this platform. Him leaving or saying that he's not going to follow through with this deal, you got to think about, does he really want to leave this deal entirely, or is that kind of the face that he's putting on so that to bring the price down and come in and kind of fill this power vacuum within Twitter? I don't know. So I just think that that's interesting. They're losing some executives. They've already lost the founder, the CEO. They're losing 2 more top executives. So I just think that that's interesting. Obviously, they've got some job cuts too that they're doing. So this is going to be something that I'm going to follow. I'm not invested in Twitter, but it's something I like to follow. I like using Twitter, and I think this is just a really interesting story. So let's head into one more article. This one is about what smart investors do in bear markets, and I'm on the Wall Street Journal today. By the way, all credit to them for these articles. But let's get into this. I found this one interesting for a variety of reasons. As you see the bear going into the crystal ball here. Jason Zweig. I hope I'm not butchering that. I'm sure I am though. Thank you for this article. We're gonna dive into it. So the first line of this article, I mean, I loved this article. I just found it really interesting. Part of what makes bear markets so unbearable is that nobody, and I mean nobody, knows when or how they will end. And I do agree with this first part. No one does know when they will end. We can have an idea. We can make educated guesses. We can look back throughout history, similar situations, and see how they played out. But it's true. No one knows when they will end. Now, how they will end, I think that's really determinant on your point of view. If you want to zoom out 10, 15, 20 years, that we can confidently say that this will end eventually with us going back into a bull market at some point, and with markets going back up. But the question is when. So this how is probably more related to just the specifics of, what's really going to bring us out of this bear market. So let's get into it. I will say, I think a lot of these articles, you got to be careful because when you're looking at news and it's for clicks, it's not always to give you the best educational advice, and that's why we're here, to break down the articles and really see what we can take from it. So they identify 3 beliefs about when bear markets will end. I just want to touch on each of them and give my thoughts. So the first is that retail investors have to capitulate. And really what that means is panic selling. So retail investors, you and I, basically anyone that invests in the market, like an individual person that is just investing on a personal brokerage, is a retail investor, for those that don't know. And to capitulate means that they're panic selling. They see the markets go down and they just keep selling because they don't want to lose their money. They're afraid the market's going to go way down and never come back up. So they sell their assets. And they say the only trouble is this capitulation is not what happened in 1932, 1974, 1982, or 2002. Bear markets sometimes end in a selling frenzy, but they often end in an indifferent stupor. So this chart really sort of is a visualization of what they're talking about. So what this is the Volatility Index, or the VIX. And basically what it's measuring is fear in the markets, volatility. You can see the prior high points and peaks and when it was really spiking were during recessions. You see this is the dot-com bubble right here that we're looking at in the early 2000s. And then during the global financial crisis is its most recent all-time high. And then you see it go down to more lower stable levels, usually between 10 and 15 during a stable bull market. And you see that's what was really happening as we came out of the financial crisis into the recent years before the COVID crisis. You see that the fear was low, volatility was low. And then it spiked again and went down really fast during the COVID, that tiny little sliver, if you can see it, that recession. And now it looks like it's starting to kind of chop and build up. And, this kind of reminds me of this little section right here, reminds me of this right here before the global financial crisis. And there's a lot of parallels between these two situations that I won't get into in too much detail today, but I just find that interesting. It looks like it's accumulating right there. So fear has not spiked yet, is basically what this is saying. And we've already, I don't believe we're still 20% below the recent all-time high in the stock market, but we did enter a bear market at one point. We rallied this past week, but that fear still hasn't spiked. So they're saying that maybe we haven't seen the worst of it yet if we're going to enter a recession. And that brings them to their second point. Fear has to spike. So they're saying that fear has to spike for us to know that we've seen the worst of it and it hasn't happened yet. So that'll be interesting to keep an eye on, is, maybe we get a little bit of a rally here in the coming days or weeks. And we'll take another look at that in the charts as well. So, and the third point, which is pretty straightforward, stocks have to get a lot cheaper. So, over the recent years, some of the ratios on the market have just gotten out of control. Stocks in the U.S. especially have just been really expensive. And to really know that you get through a bear market is you have to see these valuations come down. We're in a correction phase or maybe we're going into an extended bear market, and the stocks need to become cheaper, and that's okay. That's normal. And I don't think people should panic. We shouldn't have this retail capitulation, because if they just understood how market mechanics worked and that these stocks just need to become cheaper, and that's another good buying point. So, we even though that stocks are about 20% cheaper right now, if you look at the S&P 500, I do believe it's a little bit lower than a 20% decline right now, but we haven't seen stocks really get cheap yet. They're still expensive when you look at a lot of metrics in the United States. So, and they get into that right here. Although stocks don't seem like a statistical bargain at the time, they went on to gain. Okay, so they're saying, So they were saying right here that even though it didn't look like a bargain at the time in previous bear markets, that they go on to gain afterwards. And they go on in this article about selling losers during a bear market. I think you really have to be careful how you approach that. Yeah, if you made a bad investment and now is the time where you're seeing that, then yeah, it's okay to sell that and get out of that and take a loss, because you'll have a tax benefit on a loss. You can write it off, and they get into that down here. I won't go through the rest of this article, but I want to talk about this briefly. But my personal belief is that if you invest the way you should, and that is that you have an investment thesis, you understand what you're investing in, you have a conviction, you have intrinsic reasons why this is a good investment, even if it's suffering right now and you're looking at big losses, I don't believe that you should sell your investments, because really the people that come out of bear markets the best equipped are those that really stuck to their plan. They didn't deviate. Deviation is where a lot of mistakes come in. And so I really just believe that if you stick to your plan and you keep buying while these stock prices or these asset prices get depressed, you'll come out on the other side much more wealthy and much more equipped and much more prepared for the markets that come after. And I think that's really important. That's what I really wanted to talk about, is not deviating from your plan. If you still believe, if that business, that asset has not fundamentally changed and only the price has changed, then it's a good buying opportunity, and I don't believe that you should sell. So I just wanted to touch on that really quick. Let's get into some charts, and first I want to look at the S&P 500. So I'm just using Yahoo Finance here. I want to point out that if we look right here, the S&P 500 has been rallying since about at the beginning of July. We've seen some gains on the stock market, and I really want to point out a couple of things. This chart might be confusing to you if you don't know what technical analysis is. So I just want to start there. So this is a candle chart for the S&P 500. Each one of these candles represents one day. If it's red, that means it closed lower than it opened. If it's green, then it opened higher than it closed. And the wicks just mean the price touched that during the day, but it's not where it closed. For a green candle, it opened at the bottom of the candle, closed at the top of the candle, and any wicks are just where the price went to during the day, but then receded from there. And vice versa with the red candles. The market opened at the top of the candle and closed at the bottom of the candle, and the wicks are just the prices that it touched during the day. So let's get into it. This purple line right here is the 50-day moving average. So it takes the prices of the previous 50 days and averages them out, and the line will be there at that point in time. So I really have this on the chart here. I don't have it on the ones you'll see after this, but I have it on this one because it really respected this line. There were better channel and trend lines, but this moving average was really respected through the bull market over the past year and a half or so. It really respected this line, and you see it broke and it touched this zone right here, which became important again, which is why I have it laid out there. And then it bounced back up over the line, and this was kind of our last little push upwards before this downward decline started. So and you can see that it broke above this moving average, but then now since has respected it as we move downwards. So I just want to have that on the chart for our analysis. And then I have these two zones laid out because I think this is problems that if we do see further rallying in the market, I see these as zones that will cause problems. Long term, the Federal Reserve has said that they're staying committed. We heard that this week. They're committed to fighting inflation, and they'll raise rates to do so. And that'll hurt asset prices. So I believe in the medium term, we're not going to see a continuation of this bull market that we saw in 2020 and 2021. I do believe we'll see lower prices, but it doesn't matter what you believe. I just threw this on the screen so we can actually analyze why I'm having those beliefs. So I do believe the first zone that will have issues is right here. As you can see, when it broke through the moving average, which it had respected for a long time, it touched this zone to build a base and bounced off. So as we know, previous support breaking through is now going to be resistance on the way back up. You saw that there was some more support in this zone and the beginning of this decline that it bounced off of. And then it came back and built another base, but then it dropped below and it came back up right here and it fell below. So this is a very important zone, and I believe if we do continue to rally, obviously the first point of resistance would be this moving average, but if we break through, we will have some real selling pressure right here. Between 383 and 392 on the VU. That's the Vanguard 500 index fund. That's not the actual S&P index, but it does track the same, so it's the same percentage-wise. And if we do get through here and break through, this would be another zone of resistance, and then from there, the all-time high, but I would be surprised if we got back above this zone here, especially. I'd be even surprised if we got back above this zone in the short term. So that's how we're looking right now on the S&P 500. I do want to hop into Apple, though, because this is the biggest company in the stock market. This is the biggest company in the S&P 500. So if you want to do analysis on the stock market, I do think you have to really understand what's going on with Apple because it can kind of guide the rest of the market sometimes. And you know what? I'm going to draw another zone here. I'm going to draw another zone here. Okay. So Apple is an interesting one because even though the market has been suffering, you typically see Apple outperform the market, right? So let's take a look at it. So Apple was I put this trend line here to show that it's showing strength right now, right? It broke through, found a base right here on this resistance, which was, or on the support that was resistance over here. It broke through, and let me just drag that out this way so you can get a better look at it. Okay. I apologize if you can hear my machine working really hard in the background. It's doing a lot at once. Okay, so this was resistance for Apple. It broke through, and ever since then, it's been support with the exception of it briefly breaking through here, but going back up. So Apple has been really selling off since the beginning of 2022. It came down to this support, kind of gave one last hurrah, maybe we'll make it back up. No, so it started selling off kind of sharply here. It broke through this resistance pretty easily that had been used for support and resistance in the past, and it kind of had some trouble in this range between these two zones, and that's where it is right now. It broke through this line, so it's showing some strength. I wouldn't be surprised if we get back up to here and then kind of stay in a range. I wouldn't be surprised if we're in a range for a little bit with Apple. And you could see other stocks. Oops, didn't mean to do that. You could see other stocks on the market really correct. And so you can see the market go down while Apple stays in a range because there are other companies that are still a little expensive. So that's where we're at right now, in a range with Apple, but it's got some short-term strength to it. And just one last one. Hop into the Bitcoin. I got the weekly chart, so each candle represents a week. And man, it's not looking good on Bitcoin. We had the high around 60. I do believe the high was around 68,000. It's been selling off sharply since November. You can make the argument that, there's a line of support right here, and it's bounced off of that, but it could get up to here. Maybe it could convene at this trend line in this zone right here. I wouldn't be surprised if it got to about 27,000 and then sold off some more. But to me, Bitcoin doesn't look good, and I wouldn't be surprised if we got even lower to even 10,000. And I know no one wants to hear that, but you just have to be careful. And Bitcoin really is the S&P 500 of crypto. Like, it really guides the market. It's the biggest cryptocurrency in the space. So if you're holding altcoins or anything like that, you really, really need to be careful because they could get hurt more than Bitcoin, and Bitcoin's not looking good. If it goes down to this 10,000 level, that's another 50% off the current price, which is already very depressed. So long-term bullish on Bitcoin, but you have to be aware of these things. So that's where we can stop for now. So I just want to thank you for joining me on this first weekly wrap. I'm really excited to start doing these again. I'm going to start pushing out special series, and you can find those on YouTube and wherever you find your podcasts. And what's really important is to not get caught up in all the hype around investing, whether it's to the downside or the upside. Stay true to your plan. Stay true. Do not deviate, and just execute. And you know what? I'll see everybody next week. Have a good week, and I'll see you in the next one. So, bye-bye.